Hi, I'm Wayne Blanchard. I'm a certified financial planner and a member of the Garrett Planning Network. We're going to talk about what does the debt to mortgage payable represent. Now, I'm not quite sure about this question, so I'm going to try to explain it maybe two ways. Debt to mortgage payable, that can mean a couple of things. In an accounting fashion, debt to mortgage payable is how much debt do you have on your books compared to how much do you have in mortgage debt on your books. So it's two different kinds of debt you could have, and they are how much of one to the other. Those ratios are used because mortgage debt is normally amortized over a lot longer period of time than, say, if they had a debt on office equipment and those type of things. So your ratio of your regular debt to your mortgage debt could be important in some business transactions. In all probability, what we're really talking about here is debt to income ratio. Now, what does that mean? The debt to income really means this is more to use when lenders are loaning money to you. I don't care whether it's on a car or on a house or on whatever it is you want to buy. There are three main questions that lenders want to know about. What is your ability to pay? What's your willingness to pay? And what happens if you don't pay? So debt to income means it's going to affect what? Your ability to pay. Because your debt to income is how much debt do you owe versus how much money do you make. For example, if you have more debt than you have, if you have more monthly payments than you have in monthly income after taxes, your ability to pay is not very good. On the other hand, if you have very little debt and a very large income, then you're going to have a great ability to pay. So your debt to income ratio is simply you add up all of your monthly payments and then you divide that by your income, and that will give you a percentage. And that percentage is your debt to income ratio. By the way, for a mortgage, it should be in the high 20s. 20% would be even better. And with some of the government guaranteed mortgages, you can skirt 30%. So think about that. Your total debt, you would like to keep under 30 or 35% grand total.